On October 23, 2011, the world of Wall Street was rocked when federal investigators quietly seized the office of one of its most venerated figures, Rajat Gupta, former managing director of McKinsey Company, and a trusted advisor to presidents, CEOs, and the United Nations. In a single, unassuming raid, the curtain was pulled back on a secret network that linked the polished boardroom of America's most respected businessmen to a sprawling hedge fund empire built on stolen secrets. Rajat Gupta arrived in the United States from Delhi in 1971, armed with a degree in electrical engineering and an unshakable ambition. He earned an MBA from Harvard, joined the consulting giant McKinsey in 1973, and within 15 years rose to the firm's top post, becoming its youngest managing director in 1994. Under his stewardship, McKinsey expanded its reach across continents, and Gupta cultivated a reputation as a sage of strategy, a man whose counsel was sought by the likes of Goldman Sachs, Procter & Gamble, and the UN Secretary General. By the early 2000s, he sat on the boards of the world's most powerful corporations, and his name appeared alongside the giants of finance and industry, a symbol of the American dream for immigrants everywhere. Yet beneath the accolades, a quieter relationship was forming, a friendship that would become the conduit for a crime that shocked the financial world. In 2005, Gupta met Rajaratnam, a charismatic Sri Lankan American who had founded the Galleon Group, a hedge fund that would soon dominate headlines for its meteoric returns. Rajaratnam, a former partner at the prestigious law firm of Goldman Sachs, had an uncanny talent for spotting market-moving information. Over coffee and charity galas, the two men forged a bond that transcended business. Gupta became a confidant, a mentor, and ultimately, an unwitting source of privileged data. The secret began with a single phone call in late 2007. Rajaratnam, hungry for an edge, asked Gupta for insight into Goldman Sachs's upcoming earnings. Gupta, still a board member at Goldman, shared a confidential slide that hinted at a strong quarterly outlook, a detail that, if leaked, could sway the market. A few weeks later, Gupta passed along similar whispers about a pending merger involving the pharmaceutical giant, Pfizer, and a potential takeover of a major Indian company. Each piece of information, though seemingly innocuous in conversation, became a powerful trading signal for Galleon's portfolio managers. The FBI's investigation into Galleon's trading patterns began in 2008, triggered by unusually consistent profits that could not be explained by public data alone. Undercover agents posed as investors and slowly coaxed Rajaratnam's inner circle into revealing their sources. Wiretaps captured conversations where Gupta's name surfaced repeatedly, described in hushed tones as the McKinsey guy who could pull strings. By 2010, the net had tightened. Federal agents obtained a search warrant for Gupta's home, discovering a trove of encrypted emails and a notebook filled with cryptic references to the deal and the numbers. The case erupted into public view in June 2012, when a grand jury indicted Gupta on 9 counts of securities fraud and conspiracy. The charges painted a stark picture. Gupta, while serving on the boards of Goldman Sachs and the board of directors at the American multinational, had disclosed non-public material information to Rajaratnam, who then traded the stock, netting profits of more than $5 million for Galleon and its investors. The indictment also alleged that Gupta had breached his fiduciary duties, violating the trust of shareholders and the integrity of the corporate governance system. The trial, which began in March 2012, was a masterclass in courtroom drama. Prosecutors presented recorded phone calls, text messages, and testimony from former Galleon employees who turned state's witness. The most damning evidence came from a former Goldman Sachs analyst, who testified that Gupta had whispered, "The numbers look good, you'll want to buy," before a crucial earnings release. Defense attorneys, meanwhile, painted Gupta as a well-intentioned mentor whose casual conversations were misinterpreted, arguing that the information he shared was either already public or not material enough to influence market behavior. Despite the defense's efforts, the jury found Rajat Gupta guilty on all 9 counts after less than 12 hours of deliberation. The verdict sent ripples through the corporate world. A man once celebrated on the cover of Business Week had become a cautionary tale of ethical lapse. On June 21, 2012, the judge sentenced Gupta to 2 years in federal prison, a $5 million fine, and 3 years of supervised release. The sentence, though shorter than the maximum statutory limit, underscored the seriousness with which the court viewed the betrayal of fiduciary duty. Gupta's fall from grace reverberated far beyond his own fate. McKinsey faced intense scrutiny for its internal compliance procedures, prompting the firm to overhaul its conflict of interest policies and introduce mandatory ethics training for all partners. The boardrooms of Goldman Sachs and other financial institutions revisited their information barrier protocols, tightening the walls that separate confidential corporate data from the trading floor. Moreover, the case ignited a broader conversation about the culture of elite networks, where personal relationships can blur the line between lawful advice and illicit insider trading. In the years that followed, Gupta served his sentence at a low-security federal facility, emerging in 2014 a changed man. He publicly expressed remorse, acknowledging that the privilege of trust carries an immutable responsibility. Yet the stain on his legacy endured. He was stripped of honors, his name removed from scholarships, and his autobiography, once slated for publication, was shelved indefinitely. Subscribe to The Verdict for more stories like this.